A few days ago, a software company reported that it grew its product revenue by 34% year over year. In the same quarter, it added 17 people to its payroll. Not 17,000, 17. That company is Snowflake, and I want to be careful about what the number does and doesn't mean, because it's easy to abuse. It doesn't mean Snowflake replaced its workforce with robots, and it doesn't mean the company is shrinking. What it means is narrower, and I think more interesting. For one large, public, growing software company, the link between how fast revenue grows and how many people you have to hire to support it came apart this quarter, and management told you exactly why. There are two stories you're going to hear about this report, and I think both are wrong, or at least incomplete. The first is the doom story. AI is going to hollow out enterprise software. The seat license model is dead, and companies like Snowflake are about to be disintermediated by whatever foundation model is in the headlines this week. The second is the hype story. This is just one more quarter of an AI bubble inflating. The numbers are a sugar high, and none of it survives a recession. This report doesn't support either one. What it shows is more specific and harder to dramatize, which is why most of the coverage skips past it. It shows what it looks like in a set of audited financials when AI stops being a slide in a strategy deck and becomes a line you can trace through the income statement. Snowflake didn't just talk about AI on the call. It used AI to grow its own revenue, and it sold AI that helped its customers do the same thing. The 17 hire number is where those two facts meet. So that's the question I want to answer. Not is Snowflake a buy? I'll get to why that's the wrong frame at the end. The question is whether a software company growing a third in a year while barely hiring is a durable change in how these businesses work, or a number that falls apart the moment you look closely. To get there, I read the release, the call, and the guidance. Start with why the market reacted the way it did, because the context matters more than the headline. For most of 2026, software stocks were not winning. They were getting hit. The whole enterprise software complex had been selling off on a single fear, that generative AI would commoditize them, that any company whose moat was "we built workflow software" would get flattened by a model that could build the workflow on demand. Snowflake itself went into this print down around 20% on the year. ServiceNow had fallen more than 30%. Adobe, worse. The market had decided that the picks and shovels companies, the ones selling the infrastructure of the last software era, were on the wrong side of the AI transition. That's the backdrop, and it's why the reaction was so violent. When Snowflake reported and the stock had its single best day ever, up 36% and as much as 38% in pre-market, it wasn't just one company beating estimates. It was the first hard piece of evidence in real revenue that the disruption thesis might have the direction backwards. The rest of the sector moved with it. ServiceNow and Oracle added more than 6%. Figma was up around 7%, Palantir 8%. Microsoft, Palo Alto Networks, and Atlassian each gained at least 3%. Salesforce was the exception. It fell on its own soft guidance, which is a useful reminder that this wasn't indiscriminate. The market was rewarding something specific. For the last 2 years, the cleanest way to make money on AI was to own the hardware. You bought the company selling the shovels, the chips, and the compute, because everyone was building and the builders all needed the same picks. That trade worked. But selling shovels has a structural weakness. It only pays as long as people keep digging, and it never tells you whether anyone is finding gold. The question hanging over the entire build-out has been whether the software sitting on top of all that compute can turn it into revenue, whether the spending becomes a product someone pays for, twice. Snowflake's quarter is the closest thing we've had to an answer with real numbers attached, and the answer for one quarter and one company is yes. The demand shows up not as a promise but as consumption you can bill for, which leads straight into the financials, because how Snowflake gets paid is the whole story. Here are the numbers, and then why the way they're earned matters more than the numbers themselves. Total revenue came in at $1.39 billion, up 33%. The figure management watches, product revenue was $1.33 billion, up 34%. That growth rate is accelerating, which is the hard part to fake. 34% this quarter, up from 30% the quarter before, up from 26% a year ago. Earnings were 39 cents a share against a Wall Street estimate of 32. Net revenue retention, how much more existing customers spend this year than last, rose to 126%, and management did something uncommon for an enterprise software company in the first quarter of the year. They raised the full-year product revenue guide. to $5.84 billion from $5.66 and lifted the full-year operating margin target on top of it. The growth was also broad rather than one whale. Snowflake added 616 net new customers in the quarter, the most it has ever added in a fiscal first quarter, up 38%. The number spending over $1 million a year climbed to 779, with 46 crossing that line this quarter against 26 a year ago. 64 now spend more than $10 million. It added 13 of the Global 2000, the world's largest public companies, versus 4 a year earlier. And remaining performance obligations, the contracted work not yet recognized, grew 38%. That is not the signature of a single large deal flattering one quarter. It's a lot of customers, large and small, choosing to spend more. A first-quarter guidance raise sounds like a small technical thing. It isn't. Most enterprise software companies stay deliberately conservative early in the year because they have 11 months of uncertainty ahead. Raising the annual number in Q1 means management is confident enough about the back half to put it in writing. Where does that confidence come from? To answer it, have to understand that Snowflake doesn't make money the way most software companies do. The traditional model, the default for 2 decades, is to sell seats or licenses by the year. A salesperson sells you the right to use the product for the next 3 years and books that contract up front, which produces nice, predictable revenue whether or not you ever log in. Snowflake is consumption-based instead. It's metered, like the electricity or water running into your house. The company only recognizes revenue when a customer turns on the tap, when they run the queries, store the data, burn the compute. Nobody can pre-sell 3 years of usage to flatter a quarter. So sit with what that implies about the 34%. It wasn't manufactured by signing a few big multi-year contracts before the quarter closed, and it wasn't pulled forward from future years. It is thousands of customers in the quarter, running data and running analysis and calling AI models against it and burning compute to do all of it. The revenue is a measurement of usage that already happened. That's why management can raise the annual guide in Q1. The forecast is built on consumption that's already in the data, not on contracts they hope to close. The growth was used, not sold. That reframes the report. It's about more than a good sales quarter. The engine underneath the company is changing shape from a place where companies park their data into a place where companies run things on it. But the moment you say that, a skeptic should get nervous, and I want to give the skeptic full credit before going further. The problem with everything I've said is this. Right now, the entire market is starving for AI. Companies want to try it, investors want to fund it, and every management team wants to tell you a story about it. In an environment that hungry, a 34% jump in compute consumption is exactly the kind of number you should be suspicious of, because it's exactly the kind of number that shows up when everyone experiments at once, and nobody has decided yet whether the experiment is worth keeping. So the real question under the headline is the one that separates an AI bubble from an AI business. If customers are treating this as a toy, kicking the tires and running a few demos because their board asked what their AI strategy is, then the consumption is real for a quarter or two, and then it falls off a cliff because nothing underneath makes it continue. That's the bear case, and it's serious. Consumption cuts both ways. The same flexibility that lets revenue accelerate when usage rises lets it collapse when usage stops. A seat license company can lose a customer and still collect on the contract until it expires. A consumption company watches the revenue evaporate the same quarter the usage does. The model that made the 34% so credible on the way up gives you no floor on the way down. But if customers have wired AI into a process they actually depend on, using it for parts of finance or compliance or sales or research the business genuinely needs, then it stops being an experiment and becomes infrastructure. Infrastructure doesn't churn. You don't rip out the thing your compliance team now runs on because the economy softened. That's the line. On one side, a science project that gets cut in the next budget review. On the other, a dependency. Whether Snowflake's number is durable comes down entirely to which side its customers are on. Which is why the CEO, Sridhar Ramaswamy, built the whole quarter's narrative around a phrase, the agentic-enterprise. It sounds like a slide deck abstraction, and mostly it is, but there's a concrete idea under it, and it's how Snowflake is trying to push customers from the toy side of that line to the infrastructure side. Think about how a company used to relate to its own data. It stored it in a warehouse, which is a passive arrangement. The data sits there. To get anything out, you needed specialized engineers who could write complex queries, build pipelines, clean and model and analyze. For an ordinary person in the business, a sales manager or someone in finance or HR, the data might as well have been behind glass. The barrier was high enough that most of it never got used. Snowflake's pitch inverts that, and it rests on 4 pieces: a single governed foundation of enterprise data, access to the leading AI models, connections out to the company's other applications and workflows, and a control layer that turns a person's intent into an action the machine takes. The first 3 are plumbing. The fourth, turning intent into action, is the one that matters, and it's where the 2 products you need to know about come in. The first is Snowflake Intelligence. Picture a modern company as one enormous computer, except instead of one hard drive, it has hundreds, each belonging to a different department, with its own systems and its own data. Snowflake Intelligence is the natural language layer over all of it, the assistant you can just talk to. Whether you're in sales or finance or HR, you ask a question in plain English and it goes into the underlying databases and brings back the answer. No SQL, no analyst in between. If you've used a voice assistant, it's the same basic promise, pointed at the company's own books instead of the weather. The hard part isn't the conversation. The hard part is doing it without letting anyone pull data they aren't cleared to see, which is the whole reason a generic chatbot can't do this, and a governed data platform can. The second product does the quiet, heavy lifting in the back, and it's called Cortex Code. Internally, the engineers call it Coco. Think of Coco as a tireless junior engineer who happens to be an expert at the unglamorous work of building data pipelines. It's aimed at developers. It writes code, cleans data, builds the plumbing. Coco went generally available on February 5th, the first week of this quarter, and by the time of this report, more than 7,100 customer accounts were actively using it. Snowflake said separately, in April, that over half of all its customers now use it. The accounts using Snowflake Intelligence more than doubled in a single quarter. And here is the mechanism that makes Coco more than a productivity feature, the part an investor needs to see. On the surface, Coco helps developers write code faster. Underneath, it solves Snowflake's own biggest growth bottleneck. The old problem was that even when a customer paid for Snowflake, the difficulty of building data pipelines meant most of their data just sat there, rarely queried, rarely analyzed, never touched by AI. The data wasn't flowing, and Snowflake only gets paid when data flows. Coco collapses the cost of building. A pipeline that took an engineer days to write now takes minutes, so they build more, query more often, run heavier analysis, call more models. The cleanest way to put it, Snowflake sells you the shovel and Coco is the company handing you a free, fully automatic excavator. You don't end up spending less money. You dig vastly faster, and the more you dig, the more fuel you burn. In Snowflake's business, that fuel is compute and data consumption, which is to say revenue. Coco earns some money directly, but its real job is to be an accelerant on the thing the company is actually selling. That's a flywheel, and a flywheel is the kind of structure that turns a one-quarter spike into a durable trend, if it's real. So let's go see whether the least flexible companies on Earth are actually using the excavator. The most convincing evidence isn't in the technology, it's in who's adopting it. And the customers Snowflake pointed to aren't startups looking for an edge. They're some of the most conservative, most heavily regulated institutions there are. The first is a large U.S. bank that spent nearly 2 years migrating its data off a legacy Teradata system onto Snowflake. 2 years is not a casual upgrade for a bank. It touches legacy systems, compliance requirements, data structures, access permissions, business continuity, every step of which has to not break. So why go through that pain at all? Because the old on-premise systems, the Teradatas of the world, were built in an era when data was kept highly structured and locked inside specific physical servers. Safe and stable and nearly impossible for a modern AI to use. A large language model needs a flexible cloud environment. It needs to summon elastic compute instantly, read across all the data at once, and connect structured records with unstructured text and business processes and outside applications. If the bank's data stays in that old vault, its compliance data is like gold bars in a sealed safe. Extremely secure, completely unspendable. The point of the 2-year migration is to turn those bars into something that can move and settle and inform a decision in real time. And the moment the bank finished, it built AI-driven regulatory and natural language analysis on top, which tells you the migration wasn't for storage. It was to make the data usable by AI. The second case is a global wealth management firm that gave its entire executive leadership team an agent called, plainly, Ask Your Data. Picture what a cross-departmental view used to require. An analyst spending days pulling tables out of several systems, reconciling the definitions, cleaning it, assembling a report. Repetitive manual labor. More than 60% of the questions that used to route through an analyst that way are now answered on demand against the firm's existing Snowflake data in seconds. That goes well beyond a faster report. It changes how people inside the company get information at all. You see the same pattern elsewhere. Thomson Reuters, the global provider of legal, tax, and regulatory information, is turning complex regulation into usable insight. Nestlé is rebuilding its operations around enterprise data products used by more than 50,000 people. The Depository Trust and Clearing Corporation, the plumbing of the financial system itself, is expanding its use. Notice the common thread. These are banks, a legal and tax provider, the clearing system, about the most sensitive, most compliance-bound industries that exist, and they don't casually connect a core process to a toy. What Snowflake is really trying to prove isn't that AI can analyze data. Plenty of things analyze data. It's that AI can safely use data, inside strict governance and permission controls, in industries where getting it wrong is a regulatory event. If those institutions are crossing that line, it's the strongest signal that the consumption isn't an experiment. But analyzing data, however valuable, is still only half the ambition. And the company's most telling move this quarter was about the other half. There's a meaningful difference between an AI that answers questions and an AI that does things. As long as it only looks at your data and tells you what it found, it's a very good search engine. The moment it can take an action on your behalf, you've crossed from advice into execution, and that's a real jump. That's the line Snowflake's newly announced acquisition is meant to cross. The company said it intends to acquire a firm called Natoma, a small deal, about 20 people, and it's worth understanding why a 20-person acquisition got airtime on an earnings call. Natoma extends Snowflake's control layer beyond the data warehouse and into the everyday software where work happens. Slack, email, the company's internal tools. It's the piece that gets you from insight to action. It's also strategically different from what most companies mean when they say they've added AI. Most enterprise software is bolting a chat box onto an existing product, a feature. A control plane is the opposite. It's the layer that decides what actions get taken, where, and under whose permissions, across all the other software. Owning that layer is what lets an answer become an action, without the data leaving the secure environment. It's the difference between a tool that tells you what to do and a system that can do it. And it's not something a competitor replicates by shipping a feature. The control plane also solves a specific problem with enterprise AI, the conflict between convenience and security. In the old way of doing this, if you wanted an AI to open a ticket in Jira or post a summary in Slack, you had to pipe your data out through various third-party connections. Under enterprise security standards, that's the equivalent of drilling a row of small holes in the company firewall, and every hole is a potential data leak, a permissions problem, a compliance risk. Natoma keeps the user inside the Snowflake environment. You tell it, in plain language, to email the sales decline analysis to your manager and open an investigation task in Jira, and that intent gets turned into code and executed inside Snowflake's own secure sandbox. The core data never has to leave for the open internet. That's the mechanism that lets insight to action be safe enough for a regulated company to use. But solving the security problem surfaces a bigger one, and I'd want a management team to be honest about it. If the AI hallucinates or executes the wrong action, the damage in an enterprise system can be severe. A single wrong automated action can hit customer service, internal systems, even break a business process. So the real test isn't whether the demo works. It's whether Snowflake is willing to point this system at its own critical customer-facing operations, the ones where a mistake actually costs something. And that loops back to the number I opened with, because the answer is sitting in the headcount. Remember the 17 hires, the fuller version. Snowflake added 190 employees this quarter, against roughly 400 in the same quarter a year ago. Of those 190, 173 came from the Observe acquisition, an acquired team folded in rather than traditional hiring. Strip Observe out and organic hiring was 17 people. The CFO said it in plain terms on the call. So the question stands. How did an entire growing multinational absorb that much additional business with effectively no new staff? Because it ran the same playbook on itself. Snowflake didn't just sell Cocoa. It embedded Cocoa into its own operations, and the results are in the disclosures. Across its global support organization, Coco now analyzes incoming customer cases before an engineer touches them, surfacing the likely root cause up front. Case resolution got more than 25% faster, and throughput per engineer rose by 25%. The team that keeps Snowflake's own cloud running, the site reliability engineers who used to comb through tens of thousands of lines of logs to find one hidden failure, cut their complex case resolution time by nearly 30% and the time spent per ticket by roughly 40%. Across finance, marketing, sales, and HR, the company automated a large number of internal workflows in a matter of weeks. So when you ask whether Snowflake trusts its own system, the answer is that it's already running its own business on it. That's what produces the 17 higher number. Not magic, but its own AI tooling lowering the need to add people as the business scales. It's worth being precise about why that matters, because for the whole history of enterprise software, there's been a kind of curse. To double revenue, you had to massively expand the team. More salespeople, more implementation staff, more support, more engineers. Headcount grew with the customer base, roughly in line. This quarter shows that link loosening, at least in some processes. AI is letting the company handle more business with fewer people. I don't want to overstate it. This is one quarter. The 17 figure won't repeat cleanly, and management itself flagged that if growth stays this hot, the lean hiring could strain execution. But the direction is the thing. The production function of software, the relationship between inputs and output, is changing, and you can see it in the financials rather than hear it in a keynote. There is a cost to all of this, though, and it's the obvious objection, so let me take it head on. When you call AI this heavily, internally, and from your customers, a new financial problem surfaces, and it's a real one. Large language models are billed by usage, essentially by the token, and they run on expensive GPU clusters. If every employee starts dumping documents in to be summarized, and every team is constantly calling a frontier model to run analysis, the natural worry is that Snowflake's own server costs explode, the gross margins get eaten alive, and customers pull back because it's simply too expensive to use. That concern is not hypothetical. It's the central financial risk in the entire AI application story. Snowflake's answer comes in two parts, and both matter because together they're why the margins held. The first is on the product side. Intelligent model routing. Not every task needs the most powerful, most expensive model. Ramaswamy gave the example himself. He'd recently used the system to summarize a set of Slack threads, and as he put it, small models from a provider like Mistral are perfectly good for that. You don't need the most expensive frontier model to summarize a chat log. So the system routes the simple jobs, the summaries and the basic classification, to cheaper, smaller models, and saves the expensive ones for work that needs them. On top of that, Snowflake lets customers set hard cost ceilings, at the account level, or even for a specific agent. A budget that warns you as you approach it, cuts off access when you hit it, and refuses to go past a hard stop. That matters more than it sounds, because what enterprises fear isn't expense, it's uncontrolled expense. Give them a predictable ceiling and they'll let usage run. But that controls the customer's cost. What about Snowflake's own margins? Here the CFO, Brian Robbins, was direct. Yes, AI products like Coco carry lower gross margins than the core platform because the AI calls consume more expensive compute. That's just true. And yet the company held its full-year product gross margin guide at 75%, which is very high. So how do you square expensive AI compute with a 75% margin? The answer is that Snowflake offsets the AI margin pressure by driving down its underlying infrastructure cost. This quarter, it signed a 5-year, $6 billion agreement with Amazon Web Services, more than double its previous deal, including AWS's own Graviton chips and GPUs. By committing to that volume, Snowflake gets better pricing on the compute and storage underneath everything. It's bulk buying. Snowflake is confident enough in the AI-driven consumption coming that it can make a much larger long-term commitment, and AWS, to lock in a customer that size, gives more competitive pricing. The bandwidth and infrastructure savings dilute the margin pressure the AI products create. The picture is actually a little better than it looked, because Snowflake is carrying roughly 150 basis points of margin drag this year from the Observe acquisition, so the raised-up operating margin guide is happening despite a known headwind, not in the absence of one. It also held its free cash flow margin target at 23%. One honest caveat, though, it's a balanced equation for now. It works as long as the cost curve of compute keeps falling and the consumption keeps rising. It's a managed tension, not a solved problem, and the kind of thing to keep watching rather than assume. let me try to land this without selling you a conclusion. What the report really shows isn't that Snowflake is a good stock. It's that for one company, AI has stopped being a future ambition and become the present driver of a third of its revenue growth, and that the company found, for now, a workable balance between product margins, infrastructure cost, customer demand, and internal efficiency. That's a useful real-world sample of what enterprise AI commercialization looks like when it works. But I'd hold it with both hands. The headline growth is flattered slightly by the Observe acquisition. The 17 higher figure is striking and won't repeat cleanly. The margin math is a balance the company is actively managing, not a law of nature. And the durability, whether this consumption is wired into processes or still partly experimental, is the one thing a single quarter can't prove. The thesis holds, and the quarter was strong. That still tells you almost nothing about the next 4. If you want to track whether this holds rather than react to the next headline, 3 things are worth following. First, net revenue retention and consumption durability. Does that 126% hold, or does usage flatten, which would be the first sign of a consumption cliff? Second, the AI gross margin trajectory. Whether routing and the AWS deal keep that 75% intact as AI scales, or whether the dilution starts winning. Third, whether the headcount pattern persists, whether revenue can keep growing well ahead of hiring across more than one quarter, because that's the real test of whether the production function has changed. The rest is noise. Step back from the single stock and the bigger picture is what matters for you. Across the bank's compliance data, the wealth firm's executives, the support queue, the SRE team, what we're watching is AI moving out of the category of things you can have an opinion about and into the category of things companies quietly run on. From a technology you discuss into a part of how the business operates. That shift is the story, not whether one ticker was up 36% on a third. So bring it all the way down to an individual or an ordinary business. I don't think the useful question is whether you should invest in AI. Markets will sort that out, loudly and imperfectly, over years. The more useful question the one Snowflake's quarter actually poses is whether you've started to use it, to understand it, and to wire it into how you work. You can choose not to invest in it. It's getting harder to justify choosing not to understand it. This is not investment advice. It's how I'm thinking about it. I'll see you in the next one.